Hi everyone, welcome to the channel. If this is your first time here, please hit that subscribe button. I would truly appreciate it. In today's video, we are going to be looking at my 4 top picks on the JSE going forward from 2022. So it's not necessarily my 2022 picks. Some of these stocks I already have in my portfolio, and I am still a strong believer in them. But we will jump straight into it. We're going to look at 4 stocks. We'll look at the fundamentals of each business and why I like it. And then we'll also look at the technicals where we could find the ideal entry to get into the stock. Now, before we get into the stocks and my companies that I've picked, please, I just want to remind you that this is not financial advice. This is just my research and the stocks that I am holding, and what I want to do is share that with you so that you have the information to add to your research that you already have and maybe help you in your decision making. So just a reminder, don't constitute this as investment advice, just use it as research. All right, let's get straight into it. So my first stock pick is Prosus. That's simply because I like the company. It's got a lot of cash at the moment, and I think the prospects going forward will surprise a lot of people. It is a spin-off from Naspers. Naspers' asset at the time was Tencent. They're holding in Tencent, and the discount to NAV has always been there for Naspers shareholders, and they spun off Prosus to try and unlock some of that discount, and they bundled the holding of Tencent in Prosus. You can see the group structure there on the screen. Naspers still is the majority shareholder in Prosus, but Prosus is the underlying company that owns the Tencent shares. Now, there's always which one should you go? Should you go Naspers? Should you go Prosus? I've gone Prosus. I like the company. I think if Naspers is ever looking to unlock further value within their business, they might reduce their stake in Prosus a little bit. And also the dividends get paid straight to Prosus. So I think holding Prosus directly, you would receive those dividends, and then you would still have to pay those dividends to Naspers shareholders. So if you're a shareholder in Naspers, you would rely on Naspers needing to pay the dividends out from Prosus to Naspers. That's my understanding. But I like the business. You can see how it's broken down. They are an international internet assets division of Naspers and an investment group that focuses on consumer internet companies. And they also like food delivery, mobile banking, the fintech world, and education. So I like those. They are strong points. I believe they will develop into something very prosperous in the future. Let's look a little bit more into their financials and how much cash they are actually holding. So before we do that, just take note that the current market cap on Prosus is 2.81 trillion rand. So that's a lot of money. It's not necessarily the money, it's just the market cap. The current price of Prosus is 1,363 rand a share, and their PE ratios fluctuate between around about 8 to 10. Dividend yield is a bit low, but it is a growth stock. They reinvest their money back into the business. They've also actually issued new bonds at a new rate. They're raising capital. They are also going to receive a lot of money from Tencent disposing of other Chinese stocks like JD Group and a few other companies. So there's going to be a lot of cash coming into Prosus in the coming months, in this coming year. And if you're a shareholder, I think you're going to significantly benefit from that through dividend repayments, rebuying back shares, and just making general investments into startups that could flourish into the next big thing. So I like it. Let's see why. The financials are very attractive. I just want to point out that this is to the 30th of September, 2021. So it's not a full year. We have to wait for the next financials to be released. And then we can work out the full year profits, full year revenue. But based on as at of 30th of September, 2021, the balance sheet on the left is based, it's balanced in US dollars. So I did convert it to rands to make it a little bit simpler for those of you in South Africa. Current exchange rate that I used was 15.37. The revenue that they pulled in, all right, this is not the income statement, but this is the balance sheet on the left. But the revenue that they pulled in was 16.6 billion, which is about 255 billion rand. And the group profit, so net income after paying salaries, expenses, was 44.57 billion. So rounded up, you could say 45 billion rand. Okay, so that's big money. That's a lot of money in their pocket that's coming in, and a lot of money they are keeping as well. So they have to reinvest that money either by acquiring new businesses, building a bigger stake in existing businesses. They could reward shareholders by rebuying back shares, or by paying out dividends, or they could do a combination of all of those, which ideally is what they will be doing, I believe. We already see them, they're planning on doing it. They've let shareholders know their plans. So I like that. Future growth, future money coming out, future value. Very neglected at the moment because it's been tainted by the Chinese stock. People have sold it heavily. So I think it's going at a reasonable price at the moment. Total assets, mind-blowing, 1 trillion rand, 70.83 billion dollars. That's a lot of money. Total assets. Total liabilities is what they have to pay out, obviously, and that is 248 billion. So you can see the total assets that they have. Even if the company went bankrupt today, they stopped everything, they sold all their businesses, you're left with 840 billion just sitting in equity, businesses that they can sell, money that they can get. So that's a lot of equity in there. And I don't think Prosus is going anywhere. So it's reasonably safe compared to other businesses that might be starting out. So you're getting a high growth stock here, investing in European markets, fintech, education, food delivery. All three of those trends are doing well. Food delivery is struggling a little bit, but that's how businesses work. They go through cycles and sometimes they don't work, but the cash that's coming in that's supported from Tencent through the dividend streams is what's attractive, and which continuously gives the company Prosus cash flow and income. So in the short term, current assets is about 14.95 billion, 229 billion, and current liabilities is what they have to pay in the short term in the next 12 months. You can see that's at 73.46 billion. So they've got cash that they can get very quickly by selling assets, cash on hand, quick inventory things that they can dispose of to raise the capital if they ran into debt. So they've got over 3 times more than what they would actually need if they needed to pay debt. So their debt is very small relative to their income or the money that they have on hand. So that's very attractive. They don't need to raise debt unnecessarily if they don't want to. All right. So them issuing bonds at new rates is interesting because they obviously have a plan of where they're going to move the money, what they want to do. So there's a lot of cash that they are going to invest. So it's exciting. It's also, they have to be prudent, of course. Obviously, you're not going to invest in a company where they're just throwing the money away. So you have to keep track of where that's going. You can see the cash on hand that they already have, almost 100 billion rand. And the dividends that they just received from Tencent alone was almost 9 billion rand. So very good. I like it. The operating loss of the business, they didn't lose money. It's because they invested into new businesses like food delivery and edtech. So that's just the breakdown of that. Let's go to the next slide and have a look at some more. We're going to look at the technicals now of it. Now, knowing the fundamentals, the growth aspects of where the business is going, I like that. Of course, there is risks, all right? There's regulatory risks. There's also the Chinese risk of, can foreign owners own the shares? But I think out of all the Chinese companies, Tencent is going to be the one that is well protected. And I think their share structure is actually already, it's better than what Alibaba is invested as. And I think you are safe as a foreigner owning those shares through Prosus. So putting that aside, we can look at it on the technical side. We can see that Prosus collapsed from their high of almost 2,000. And that was just purely because of the Chinese economy, the Evergrande situation, the foreign ownership's not really holding the shares in a Chinese company. It's been held off an offshore account, so you don't own the shares directly. I forgot the terminology. I think it's a structure, a certain structure. But what it means is that if you buy a listed share on the New York Stock Exchange through a Chinese company, you are indirectly buying a foreign company that holds the shares like a proxy. So you don't own the shares directly. I will type in the comments what that name is. It's just slipped my mind now. But that's why the share sold off, got really bad, and I think blood on the street even. Lately, Prosus has been putting in a base, and you can see this is starting to slowly pick up here. And in matter of fact, it's above its 200-day moving average, and it's pulled back to retest it. So as long as it can hold there, I believe that Prosus will start moving its way up. Maybe it might not move up aggressively this year, but I think the long term, this is a winner, or at least one that offers you a good hedge and a bit of safety in the process. So that's the first pick, Prosus. Let's have a look at pick number 2. Pick number 2 is Storage, which is a property REIT, a real estate investment trust, also listed on the Johannesburg Stock Exchange under the ticker code SSS. Currently, their market cap is around about 6.5 billion rand. So it's not a big company. It's compared to Prosus. And their current price, their selling price is 14.97 rand. And the dividend yield is, it's decent. It's juicy. It's above interest rates, 7.4%. So if you put 10,000 rand a year, or if you have 10,000 rand invested, you're going to get 7,400 rand out in the process. Sorry, not 7,400, you're going to get 740 rand out. Otherwise, you'd be getting a 70% yield. Then I would say jump in straight away. So you invest 10,000, you get 740 rand a year. It's going to take you 10, 11, 12 years just to get your capital out from just getting dividends. Now a REIT, if I'm not mistaken, has to pay 75% of their profits out as distributions. And just remember, when you're getting paid through a REIT, you're not taxed on that. So you have to declare that as income when you get that. So if you are in a tax situation where your tax is too high, or you're trying to balance your books, just take note that if you invest in a REIT, the distributions you're receiving aren't taxed. So it's your onus, the onus is on you to declare that as income. Usually when we get dividends from companies, it's already got that flat 20% tax taken off. So it's a less of a worry for us. So that's just something to take note of. All right, they got a PE ratio of 7, fairly priced. It's a growing company. I like it. Out of the REITs, this is my favorite. I did like a couple of others until I started looking at this one. This one is a resilient business. I think in all economic cycles, it does well. If people are immigrating, people are downscaling temporarily, storage containers, there are always a demand for it. And they are also got other streams of revenue that's not part of their core business, such as their digital platform that they are focusing on, driving traffic, using the data to benefit their customers, potential new customers, and for themselves to improve. So their digital platform is also something to look out for. Not part of their main business, but it is a growing part of their income stream, which is, it's quite interesting for a REIT to be branching off like that too. So I like it. Small company going for 15 Rand a share, dividend yield 7.4%. I think that's attractive. All right. They are a specialist in this market and they've had a great track record so far. And currently they are actually going forward into their next 5-year plan. So at the moment they are leveraging up a little bit, which you'll see on their income statements and balance sheets shortly, which is normal for any business, because every business, if they want to scale, they have to do it a few ways. They have to raise equity, or they have to use debt, or they have to issue out shares and dilute existing shareholders. They can do one or the other, or a combination of both. It just depends on cash flow situation, who the shareholders are, and obviously it's prudent management that balances it all ultimately. So REITs are a good way to get exposure to property rather than taking the risk and invest in property yourself. Less of you lose all the headaches, don't have to worry about tenants that are fighting, breaking things, not paying you rent, the maintenance on property, all the logistics that are involved with owning property. You can bypass all that, get exposure to this property market in the UK and in South Africa, and kick back and be a landlord. So I like that. And I think it's a good alternative, one that you should consider. So let's have a look a little bit more about the company. They have 76 properties. I think they went from 24 properties in 2015 to 76 in 2022. Sorry, 2020. Now we're in their next 5-year plan to 2025. So their first 24 properties were valued at about, 1.4 billion Rand. Fast forward 5 years later to 2020, they have 76 properties, portfolio properties, and it's valued at about 8 billion. So they are prudent with their capital. They take on debt when necessary to scale their business. Their return on investment comes back to them. It might not come back to them this year, might not come back to them next year, but their 5-year plan, 6 years, 7 years plan, it looks promising. Now, you could opt to invest in a business like Prosus straight away, who's bringing in the cash flow, the growth excites you, the upside is exciting. So you could go that route. You can diversify and go 1-1. All right, so I like this business. It might not be as quick as Prosus. Okay, it also has some inherent risks. The South African economy, the property, that's risks. So this is why I like this one, because the economy goes through cycles. And I think storage facilities are more resilient than commercial property or residential property. They have a bit of both, but they focus mainly on storage units. So I like that. 54 properties in South Africa and 22 properties in the UK. So they've offered you that little bit of a diversified hedge, which I like. And you can see the breakdowns of it, of where the value of that 8 billion comes from. You can see 4.8 billion from South Africa, 3.2 billion from the UK, and how that joins together there. So total of tenants, 38,400, most of them from South Africa, of course, because most of the properties. Just to mention, that is the occupancy rate, which we'll see now, is very high, which I like, because they don't have these anchor tenants like other property REITs who rely on Pick and Pay or ShopRite or Clicks or these big names to continue paying rent. So they aren't so reliant, and that makes them resilient. So that's what I like. They don't have anchor tenants, and they have 86% occupancy rate. All right, so let's have a look at some more. This is the investment case behind investing in Prosus. Sorry, not Prosus, storage. Here we go. Like I mentioned, they've grown their properties, 24 properties from 1.3 billion to 8 billion, 76 properties in 6 years. They've consistently delivered on the strategic initiatives that they set out for themselves in 2015, which has now ended, and they're moving into the next strategic initiatives that they are setting themselves for 2025, 2026, which I like. They're thinking ahead. They hold themselves accountable. They don't over leverage, which we'll see now because their loan to ratio value is also at about 25%, if I'm not mistaken, but we'll have a look at that now. There it is. Loan to value ratio is 25%, which is very good. It's telling you that they aren't using too much debt. All right, they're using a little bit of debt. It's like when you buy a house, if you've got 100,000 Rand of the money and the house is 1 million, you're using 90% of someone else's money and 10% of yours. So your loan to ratio value is going to be 90%. That's extremely high. So if you run into an income crunch, you have to refinance, get more debt, potentially sell off assets, lose money. So the lower your LTV is, the better it is and the healthier you are to withstand any shocks that come your way. So I like that. I also think storage might have one of the lowest LTVs out of all the REITs in South Africa because of their resilient structure. So I like that. That's good. You've got the diversified hedge in South Africa and the UK. All right. No tenant concentration risk, low value rentals. So it's cheap to rent the units, but very high volume. So there's a lot of demand. A niche asset class that's uncorrelated to traditional drivers of property. Okay. So that it's not reliant on certain areas having more people living there or certain businesses being in a certain district and relying on commercial properties. It's uncorrelated to any of that. And it's a tough barrier of entry to get into once you have an established business like they have got going on. So it's proved to be very resilient, even during the COVID pandemic. It's proven itself. So I'm not going to read all of it and go through all the investment cases, but it is on the screen. You are more than welcome to pause the video and read through it. Just some highlights from their financials. Dividend up, almost 9%, 56 cents a share. So it's pushing that dividend yield up that we looked at earlier. Self-storage rental income and net property operating income up 13% and 20% respectively. All right, rental income's up, which is impressive, 11.8%. To be able to increase your prices during this time and people and your occupancy rate not dropping, I like that. It shows you that it's a resilient business. People are downscaling, they need places to keep their things. People are immigrating, they want to store their things, sentimental things that they don't want to sell. It's a niche business, I like it. And okay, so property value is up to almost 8 billion. Loan to value ratio is 25%. That's what I spoke about. Debt isn't too, it's not a concern, all right, compared to other REITs, and 25% is a decent number to maintain. They completed 3 developments. They're also looking to add more developments to their rollout, their strategy over the next 5 years. And those are the main highlights I would say we need to look at. We can look at some more things now in the financials. This is the occupancy rate that I talked about. You can see that it's pretty high, 86%, 87%. That means they have income, not guaranteed. Obviously, there could be one year where they drop down to 70%, 60%, but they've proved themselves, and we can almost guarantee that their income should stay reasonably the same, but slowly increase if they can maintain price increases if they can expand their business, unlock new value, and just grow their revenue. And if they can retain that occupancy rate, that just bodes well for them overall. Now the financials, I pulled this from their site. Excuse me, it is unaudited. We'll wait for the audited versions to copies to come out, but it's interesting still to have a look at the numbers. I've put it together. Their total assets for the business itself is 8.56 billion. So that consists of their businesses and other assets that I haven't spoken about. Their property is the main one, of course. So they've got 8.56 billion in assets. Total liabilities, not too high, but 1.84 billion. Total equity, I've minus the minority holdings of the business, but total equity left after everything else has been deducted is about 5.8 billion. So if they sold everything, packed it all up, paid their debt, you'll be left with 5.8 billion. The market cap is currently at 6.5 billion. So it's fairly priced, the business, and it's got a future that doesn't look too bleak. There is growth happening. They are making decisions for future growth. They are planning this. They're making strategic bets, which is what you want in a business. You need it to grow. You need to continue, make investments, reinvest the cash, and also reward the shareholders along the way, which they naturally do because they are a REIT. Like I mentioned earlier, they have to distribute 75% of their income out to maintain the REIT status. Current assets, 245.9 million. All right, so the current assets, the cash that they can get now is pretty low. All right, their current liabilities compared to their current liabilities. So within the next 12 months, they have to fork out 1.1 billion. The reason for that is because they're expanding, they're using debt. If you look at the balance sheet, it says current liabilities, they have loans and borrowings. That's 672 million. So it's not like they're borrowing money to go and spend it on staff parties and buy depreciating assets that won't get a return. They are investing in property where they're going to get an income from the property, and potentially the property goes up in value. So as the property goes up in value, you naturally benefiting from that inflation hedge. All right, so they can revise the property up in value. That's a good thing. The cash flow that comes from that is also a good thing, which will maintain the costs to service the debt on that borrowing. The debt, I had a look at who they're paying. I think they've got Nedbank, Absa. The interest rate is fairly priced. I think the highest one was Investec at 10%. Other interest rates were 6.85%, which is fairly decent, and I think it's maintainable in this market. So that is a concern, that they have less cash on hand within the next 12 months, or cash that they can get, because if they do run into a crunch where they need capital, they'll have to dilute shareholders, do a rights issue, or resort to bank borrowings. Okay, and it looks like they go to bank borrowings. That is their way to finance these deals. Obviously, because the cost on the shareholder is cheaper by borrowing from the bank at 6% rather than diluting shareholders. So they opt for the one over the other. Okay, they might dilute shareholders too, but not as much as the debt that they borrow. So it's a balancing game. You'll have to research, look into that, keep following. And if you're going to invest in the company, you're going to keep following what they are doing, keep track of that. So their current ratio is 0.22, very tight. If they run into a cash crunch, they borrow, but the cash flow from their operations should sustain their repayments. All right, because they are profitable, so they are paying their payments off. And this is a property game, right? So property is paid off over 10 to 20 years. Okay, there's reasons for that: tax rebates, inflating debt away, keeping the bond open. Okay, I won't get into all that, but there are reasons for that. So they are investing their capital rather than holding the cash. So it makes sense, but it's also something to keep track of just in case they run into any problems. This is the property revenue. 431 million brought in from their property, and then their operating profit after paying salaries. All right, and just covering their operational costs, they left with 279 million. So that's a 65% net margin. That's not the group's revenue. That's just the property revenue that the property is bringing in. So you can see the properties are cash flow positive. So it can maintain itself. They take the income from the property that they've bought on debt at a low interest rate. You can see property rentals are climbing by 11%. So they are able to maintain the cost to service the debt to keep acquiring more properties to scale their business. That's the thing. It's the same as us when we want to buy property. We buy the one property and we think, okay, we put a tenant in there. The tenant is going to pay 6,000 a month, but I owe the bank 7,500. At least the tenant is paying 80–90% of it. That's still 1,500 that has to come out of your pocket, which reduces your affordability. So if you want to scale and buy your second property, your income that you're applying on now is lower because your first property is taking 1,500 away from you. So eventually you reach a threshold. So it's the same thing as a business, a REIT. If they want to scale, they need cash flow from their existing businesses so that they can keep scaling. All right, it works the same. So as long as they're keeping their cash flow coming in, they can maintain their debt levels. I spoke about their planning for the next 5 years, strategic planning. It's on the screen there. They have a successful record from 2015 to 2020. They're rolling out their new strategic planning. It's also led by their property strategy, which is what they're doing. That's their bread and butter. But it's also being complemented by a digital strategy. And this is what I like, especially going into the digital world of how data and information can be extrapolated and you can monetize that information that you have. So data is king at the end of the day. And they have existing data of who the demographics are that are buying and renting properties, which areas are doing well. So that if they want to make an investment and Cape Town is the area or Johannesburg is the area to invest in, they're not going to go buy a property in the Eastern Cape or Mpumalanga because it doesn't make sense. It's not viable. The cost to service the debt to acquire a property in the area is not going to suffice. It's not, the data gives them that information. So the more efficient their digital strategy rolls out, that data collection that they can have can be sold off to third parties who want to target certain people that are buying from them. And it can also just help them steer their decision-making in the correct avenue. So instead of buying in Mpumalanga, they buy in Johannesburg or Cape Town. And their return on investment compounds over that. I like it. It's part of their strategy. Brilliant. Continuing to grow portfolios through acquisitions, new developments, and third-party management contracts. Leverage benefits of low-cost emerging market head office infrastructure into first world markets. Low cost, that's their thing. They like to focus on low cost. So if it goes south, the burden to maintain that flopped investment isn't really such a bad burden, if that makes sense. Taking losses in business is normal, especially if you're going to try trial and error and you improve, you get better. So I don't see this business failing unless something drastically happens, which again, you would keep track of and follow if you invest in them. This isn't something you go buy today and sell it next week or 2 weeks from now. This is something you plan to hold. It's like buying a property. It's a long-term game. If you're gonna you can make an investment, skip storage and go buy a property yourself and manage it. But when you have the property, you're not going to go and sell it next week, are you? Maybe if you're flipping and you're good at it, but most likely you're going to hold it for 5 to 20 years. Same thing applies in the REIT. So the benefit is getting the distributions from the cash flow that comes in. Hold it for 10 years, you get all your money out through dividends, and the capital you invested is still in the company, which is growing naturally as the share price goes up if the business is scaling correctly. So I like that. These are just some of the developments in the pipelines that they've got planned. Okay, some of the areas, I won't go through it all, but you can see this is what they're using debt for to expand in these areas. Joburg and Cape Town are obviously the hotspots. This is where the money is located in South Africa. So it's the same thing. If you're living in a province where you might be battling to get a job, you're going to follow where the money's going. Follow businesses that are spending money and chase that capital. Contact them, ask them, oh, you're building in this area. I'm an architect. I'm an electrician. Are you hiring? Are you doing contracts? Because you know they've just taken debt to spend. So you have to follow the money. Just a side note. Let's look at the technicals. This is Storage's graph. And it's interesting. Only zoomed back to about 2016 since their strategy started, their first strategic strategy. This share price has slowly, gradually gone up. It's nothing wow to brag about. Okay, it's like maybe 60, 70%, which is decent. Okay, you also get the dividends along the way too. So if you're reinvesting, that return goes up. It goes through these periods of, like every other stock, where it reaches a top and pulls back. Now, where we are exactly in that cycle, we can see that they've over leveraged right now. They've taken on more debt to acquire more assets, and their strategy hasn't been proven now, their next strategy, their next phase of their strategy. So there'll be uncertainty along the way, missed revenue expectations, possibly a fire at a property, loss of income, etc., etc. General risks like that, that might coincide with a peak in the share price and drop 20%. And now if you're a long-term holder, that's an opportunity in a quality business that is proving itself and has a runway ahead. It's got a tailwind, in my opinion. So you would buy more. Before COVID, the pandemic, we had this head and shoulders pattern that was supposed to play out, was interrupted here by that break. That long sell-off was the pandemic, but it quickly recovered and it completed that second shoulder. So that's a head and shoulder. Shoulder one, head, shoulder. It had that formation, and I think it was always going to, barring the pandemic, if the pandemic didn't happen and things were just normal, that right shoulder would have probably still been put into place. It would have sold off. So it recovered after the fall, hit its low of 10. That was a beautiful time for long-term investors to acquire. You'll be 50% up now in less than 2 years. And it's slowly been picking up. And we've had this rally. You can see this strong rally up where it's hit a strong resistance line. It's hit its head now at 15. Excuse me. So it's going to pull back, okay, at some stage, which shouldn't be a frightening moment for you if you're planning to make a long investment. So if I were to, well, I am invested, but I will scale into it. So I'm not going to take all my capital and go in at once, especially if I'm using technicals for price entries. Now it's on this trend line of going up, it's hitting its head. It could easily pull back to a low of 14. Over 6 months, you might go this whole year now and be 10, 15% down. That sucks, of course. Okay. But if you believe in the company and their 5-year strategy, then you have to be prepared to hold for the 5 years. Okay. So you might not see any return for a year and be slightly in the red. And if you've got the conviction, you can buy in at a lower price to dollar cost average in, bring your price down. That is also an opportunity. So it's about the conviction, researching, and using technicals as an advantage to get in at a lower price. So it could break down, but long term, I see it moving up gradually, and that will be a 20 Rand stock within the next 5 years. Okay. Easily, I believe. That's another, what, 10, probably about 20 to 50% from now, gradually going up, getting the distributions, business slowly scaling. So you might have seen my third pick. My third pick, whoever has been following the channel or follows me on Twitter, you would know this is my favorite company, and I'm going to show you exactly why right now. The third company is Sibanye Stillwater. This is my golden egg. I'm in no rush for the share to shoot through the moon. Otherwise, I have less time to accumulate. So every day I wake up and I start with self-affirmations in the morning. And one of the things I say is Sibanye share price is going to fall today. All right, that gives me an opportunity to buy quality at a lower price for longer before it shoots up and that return is gone. So market cap, fairly priced, underpriced in my opinion, 157 billion Rand. Current price is 56 Rand 22. It's had a massive little run over the last month, almost up 20%, I think about 18, 20%. So it's starting, the wheels are starting to turn there. Dividend yield of 11%, juicy. If you're going to invest 10,000 Rand a year, you're going to get 1,100 Rand out within 9 to 10 years. 9 years, you're going to get your money back. So even if the share price didn't go up for 9 years, you get your money back. You make 100% return without the share price even moving, just from the distributions of shares. Now, this is a cyclical business, so dividends aren't guaranteed. So to bank on the dividends is risky. They might go 4 years with paying dividends, and in year 5, 6, and 7, they don't, because the commodity cycle has turned. It's gone down. And now they aren't making as much. But I believe the next decade, this business is going to do very well. Cash flow is going to continually come in. And I think leadership is going to steer the company well. Neil Froneman said he's going to retire in a few years. And his goal is to increase the market cap, increase the profitability of the company. Forgot the exact number that he said, but I have faith in him and the business and its diversified commodity base that it has going on. So you can see the SA gold production counts for 33%. SA PGMs 48% and US PGMs 19%. So it's well diversified. Still too reliant on South Africa in a way. I think that's why it's got that inherent risk and why people have stunned it a bit. So US, they expanded a while back. I think it was in 2016, 2015. Neil took on 2.2 billion as a loan. People sold the stock off eventually. Commodity prices were low. How are you going to pay this loan back? And the commodity prices shot through the roof. The loan was paid off with like 1 year's worth of earnings, which is crazy because the cash that they're bringing in is exciting. It's the same as all the deals that they made in the last year that was paid with just all the cash flow before earnings before income tax and depreciation or amortization. That was all paid for before that. And that was just 1 year's of earnings to get businesses in new jurisdictions across different geographical locations from 1 year's earnings, all paid for by cash, and still had cash left over to pay dividends, rebuy back shares. And we're going to have a repeat of it this year because the gold price has stayed beautifully at 1,800. I always hear people saying gold's going nowhere. Gold price might not be going anywhere, but the miners who are mining gold, their all-in sustainable costs are much lower than what the gold price is selling for. So the cash that they've had on their balance sheet or their income statement is going to be there the following year again. So they can increase capacity, acquire new businesses, or distribute more dividends or buy back more shares. So as long as that price stays elevated, the cash is going to come in like crazy. That's why I like it a lot. They have a very large workforce, mainly in South Africa, 84,000 employees. So there are some risks. We will look at that now shortly. But a PE ratio of 3.63, dividend yield of 11%. It's a strong buy from me. I am heavily invested, so I might be a bit biased, but I like the cash flow. You can see the storage, cash flow, dividend yield was high, 7%. The next company I'll show you after this also has a high dividend yield. I invest for cash flow. So I always got money coming in. The cash flow allows me to take advantage of market cycles. So people that are investing in high growth, if they stall and have no cash flow from dividends and the share price drops, now they are in the red, but have no cash to acquire more shares. Whereas if you invested in high dividend stocks that pay dividends and have the option of increasing the share price has the potential to increase. It doesn't matter what the shares or the economy is doing or the stock price movements are doing, because you're going to get your cash flow and you have an opportunity to take advantage of those cycles. So there are risks involved. Don't be naive to think that this company is only going to go up. It can go down 50%. I would love that. But there is always a risk for every business to fail or take a wrong turn and the business changes completely. Let's start with the risks. Collapse in metal prices and exchange rates. So a stronger rand is bad for miners because they earn their income in dollars. So it's a balancing game because commodities and dollars move inversely. So if the dollar is weaker, the rand's going to naturally get stronger. But a weaker dollar is a higher price for commodity. So if the dollars are stronger, then commodity prices go down. This is usually how it works. Weaker dollar, commodities go up because commodities are sold in dollars. When a weaker dollar goes, that means your purchasing power from third world countries increases relative to the dollar, which means you are able to buy more commodities with your local currency if the dollar is weaker. That's why commodities go up when the dollar's down, because demand goes up, vice versa. So exchange rate, there's a risk, but you've got a hedge. Collapsing metal prices, if all the metal prices go down, which I don't think is going to happen, especially with a diversified miner like Sibanye, prices are already staying flat. Gold couldn't go down lower than 1680 and it stayed flat almost at 1800 the whole year in 2020. Cash flow is going to be massive this year, 2021. 17th of February, they released their financials. They might not get as much as they had at the hype of 2020 when gold hit 2000, but it's going to be very high. And if gold moves up, then the following year is going to be even higher. All right, so aggressive expansion into other mining houses. So that's if they want to go and invest in another jurisdiction and they just go on an investment spree and they spend too much money and they get no return on the investment. Okay, that's a risk. Social political instability in South Africa is a risk. Miners strike, there's a lockdown, okay? You don't increase your production, you can't sell as much. There's obviously that inherent risk of all that. Labor relations is also a very difficult subject in South Africa. But they always have agreements, they seem to work it out, and hopefully wages are fair so that the workers who are risking their lives to extract these resources are compensated accordingly. That is down to ethics, and it should be something it's considered a risk, but it's also ethics. So it's a difficult one to balance, but they have got the cash. I think they can maintain it. Happy workforce, happy shareholders is going to equal growth. Safety records, people dying on mines, increasing costs a little bit to maintain the safety procedures, that's a risk. And missing on production volume, which is obviously, if you're not working at your full capacity, you don't produce as much as you did before. Oil price is also a risk. Oil goes up, their costs go up. Electricity crisis. In the short term, I think that's a headwind. Long term, that incompetency will be a tailwind as they become less reliant on the electricity grid. They already have mandates to increase kilowatts of how much they can produce themselves. Okay, and then also investing into this new trend of greener projects. That is a risk. We don't know how that will play out. But ultimately, they have an experienced mining team, large reserve base, so they are good. Cash yields are attractive, dividend yields attractive. PGM miners are expected to continue to benefit from secular demand. Commodity prices aren't going down, in my opinion. The demand for them is going up. Prices are going to re-rate. You have a bit of a hedge in the USA too with Sibanye. Sibanye is top 3 global PGM producer. All right, strong cash position, and they're also focusing on the green metal. So that could also be a positive, because if it turns out to be as just as everyone says it is, then it's going to be a cash machine, maybe not producing as much cash as the other operations, but it's going to be another source of income. So those are the risks and the investment cases, the long-term fundamentals. Current investors in the company shows you the Backing Public Investment Corporation, BlackRock. These are big names. Gold One International, Allen Gray, 91 SA. These are big investors, and they are investing in it for a reason: cash flow and for appreciation. Just a quick fact, this is how much money Sibanye makes per hour. Since 2003, you can see started with 2 million to 2021. From the latest financial results, 20 million Rand an hour is what they are making. So obviously I didn't work out the costs. The costs would probably be, would work that out. I don't even want to guess now, but 20 million Rand an hour is what they are producing. You can see how that's growing. What's it going to be in 2025? 100 million Rand an hour? I hope so. Let's move on to the next share. Sorry, not the next share. Let's first look at the income statement of Sibanye. This is the most exciting part, in fact. Revenue, remember, this is just ending to June 2021, so it's not a full year. You can expect this to double, so probably close to 200 billion in revenue, which is, it's crazy. So 89.5 billion revenue up to June 2021. Group profit, that's net income. That's after paying taxes, paying salaries, paying everything they need to pay. They have 25.3 billion Rand in cash, net income. That's a 28% net margin. That is incredible. That is juicy. It means they're keeping 28% of their total revenue. Most businesses are maybe about 10, 11. Exceptional businesses might be around 20. Very exceptional businesses are in these areas. This is just showing you that this is a cyclical business, and commodities right now are very neglected, and people are missing out on extreme high levels of cash flow. Cost of sales is 48.1 billion. So they have a 53% gross margin. So to get in 89.5 billion in revenue, they have to spend 48 billion. So for example, I put oil in my truck drives, I pay the miners to dig in the ground, extract that ground, transport it, do the whole situation. I spend 89 million. I spend 48 billion, I get back 89 billion. Pay my salaries, pay my logistics, pay my staff, pay my tax. I have a net profit of 28%. And they still contributed 9 billion Rand to the fiscus of South Africa, which is a big boost for the national government, because that allows them to help people through social grants, continue building infrastructure. So it's a vital company for the economy, and it's producing cash flow for the investors that are providing the capital. It's a win-win at the moment. I hope it continues to stay like that. And I do believe that it will. So that's very interesting, very juicy. we're going to look at their balance sheet. We went through the total revenue, the gross profit, net income, total assets that they have, 146 billion, total liabilities, 63 billion, total equity left, if they had to just call it up, call it quits and pack up shop, 83.3 billion. Current assets is what they have in the short term, the cash on hand, which they can pay in dividends, look for more deals, buy back shares, 63.8 billion. That's a lot of money to have just lying around. Current liabilities, what they have to pay in the short term over the next year, 23.3 billion. Okay, so they have more than enough to cover their short-term debt costs. So this company is not going into debt for no unnecessary reason. They use their cash flow for acquisitions. They use their cash flow to expand their business. They use their cash flow to pay their shareholders. No need to even contemplate taking debt to cover anything, because the business, the all-in sustaining costs are much lower than the prices of commodities. And that's what many people, I don't think, see. So even if commodity prices don't go up from here and their costs don't drastically increase, then the cash flow is coming in. So their current ratio is at 2.7. That's very good. Prosus was at 3, which was a little bit better, but that's a different ball game. This is an interesting chart that I found. Not sure where I saw it, so giving the person credits, I think it could have been from Swiss Group, so Rand Swiss, sorry, from their presentation that they put together. So if it is from them, giving credits to them, thank you for this information. This is gold. This just shows you that the diversification strategy that they have going, growth, underpins their record earnings and cash flow. So as they're increasing, their cash flow is increasing, their debt is coming down. So they are almost virtually debt-free while their capital and production is skyrocketing, which is beautiful. You want your debt to come down and you want your profits to go up. That's what we are in business for. Well, most people, I would presume. So absolutely amazing. Just shows you the breakdown of that. And then it comes to the interesting part, the technicals. On the short term, Sibanye is overbought. Okay. On the RSI, it's pretty high. It's knocking its head on 75. That's the first signal. It's hitting its head on the 200-day moving average, which is trying to claim back. That's another signal that we're going to be in for short-term pain. And it's hitting resistance at 58 Rand 20. That's where buyers sold off last time very heavily. People who have been waiting to exit, which is a mistake if you ask me, are going to exit. So in the short term, which is where I'm going to add to my position in the lower 50s, because all these indicators are signaling that we're overbought in the short term, we are due for a slight correction. And then we will reclaim the 200-day moving average. And once we are above that, then it's in an uptrend again. You can see it's already broken down from this downtrend that it was in for quite a long time. Okay, almost over a year. So it's broken out of that and it's going to retest down, because usually when it breaks out of a trend, it retests to that to see if it's going to hold and then continues going up. So I'm looking at 51, 52 as an entry point again. And that's where I think we will see a bounce. And then it will break out this resistance zone that it's at now and reclaim the 200 moving day average. Now, there is a chance of that not happening and it falls back below into that trend that you see and makes its way down to 38. But from tracking the price, I don't see that happening. I see 44 Rand holding. It's been holding. Buyers come in. I think that's the smart money that's buying. So no, it's strong hands now and it's forming a good base. So this is an opportunity, the next pullback, to buy barring any economic crashes, global turbulence in the global economy, and the share price not tanking, which is an opportunity to buy again either way, regardless. It's going to form a base at about 50, 51, 52. That's going to be the floor. And I think we could see the share anywhere between 69 Rand and 80 Rand in 2022. We'll see how that plays out. Even if it's not, the cash flow that you're going to get alone from this year and last year, if you were investment, you're already 2 years into a 7-year cycle where you can get all your money out. Now, those of you who are buying Sibanye in the 30s and 20s, it would take you 4 years or 5 years to get your initial principal out. And if you are in year 2, year 3, you've already received 70% of your money in cash flow, in dividends, and the share doesn't even have to go anywhere. So that's what I like about it a lot. All right, let's move to the fourth share, the final share. The video is a bit long, but hopefully there's some value in there for you. If you think there is value, please hit that subscribe button, share the video, tell your friend, comment in the comment section. I would truly appreciate that. All right, the fourth share, the final share. I'm going to try and wrap this up quick, not too quick. Don't want to neglect this company because it's also a favorite of mine. The fourth share is Lewis Group. Now, it's not as sexy as Sibanye, but it's sexy in its own way. All right, so Lewis Group is an under radar share, in my opinion. It's neglected to, low P ratio of 7%, nice juicy dividend, 8.2%. They are cash flow positive. They are prudent with their money. They are rebuying back shares. And they have a resilient business, which has proven itself in COVID, one of the worst times of our economic cycles. So market cap is around 3.1 billion. Current price, it's a low liquidity stock, so the price fluctuates. What you see is not what you're going to pay, and when you want to sell is not what you see is not what you're going to pay. So it's currently fluctuating between 47 and 50. We'll see now in the technicals. I'll explain why. But current price, closing price was at 47 Rand 57 cents. All right, this is South Africa's largest furniture chain, which sells household furniture and electrical appliances. You may be familiar with some of their brands already. Lewis, Bears, all right. You can see them all. Little logos. You probably see them around, driving around town. Maybe you didn't even know that Lewis Group owned them. All right, so United Furniture Outlets and Best Home and Electrical. So Lewis, Bears, United Furniture Outlets, Best Home and Electrical. And then their subsidiary, which is the insurance business, which is it's beautiful how they've set it up. Monarch Insurance, offering credit to consumers to buy their products from their businesses, furniture and home electrical appliances. Most people are buying it on credit. Obviously, there's always a cost to money you don't have that you're going to use on credit. So not only are they selling their products and getting the profits on the increases on the costs to make those products or buy those products, they're getting income on the money that they're borrowing you to buy their products. All right, so I like that business. It's good, bringing cash flow. This is how they're sustaining their dividend yield. Also a very neglected share, started buying it around late 20s, in the high 20s, I should say. And those that have been following me would know that I have been recommending the stock. Again, not financial advice, my own opinion. But let's have a look more into the business. Geographically located, I like it, all over South Africa, but also has an African presence, which contributes 15% of the group's income. Now, this is 2020 figures. All right. So it could have gone up a little bit more, could have gone less. We'll have to check that when they release their next investor relations. They have 669 stores in South Africa and 125 outside of South Africa. So they are nicely diversified. They got a nice little business going on, cash flow positive, resilient, and strong fundamentals. Let's have a look at their income statement. All right, this is just also up until the 30th of September 2021, also unaudited. So we have to wait for the audited ones to come through. There might be some variations, some changes. So don't take this at face value, but I would say it's fairly accurate unless they pull off a Steenhoff move, which I don't think they're going to do, touch wood. But anyway, revenue for the 6 months ending, 3.4 billion. Again, not as sexy as Sibanye. Sibanye could probably come out and buy this business and turn themselves into a furniture business if they want, and still had pocket change to do whatever they want with. So if you look at it in that aspect, okay, net income, 234 million. So the net margin is not as sexy as the others, but 6.8% is fair enough, especially with that juicy dividend. So they are paying out their profits nicely to the shareholders. All right, so you're looking at probably about just over 500,000 in revenue, in net income a year, between 500 million and 600 million in revenue, in net income a year. So the business is small, but it makes cash. Revenue is up by 12.12%. Cash generated from operations, 595 million. Merchandise sales increased 20%. So people are starting to go back and buying things. And remember, if they're buying that on credit, that translates into more revenue for them in the long run. Operating profit increased 23% to 341 million. Interim dividend increased by almost 50%. So that's a juicy dividend. And if I'm not mistaken, the last day to trade is on the 18th, which is on Tuesday. And then they'll pay their dividends on the 24th of January. So their dividends are coming soon. But be careful to buy now because the share has been rallying up. Most likely after the 18th, if you would like to take a long-term position in the company, then you would wait until ex-divi so that the share price drops and then you can buy at a lower price. But obviously you miss the dividends, but they maintain their dividends year on and year on. So again, 8%, if you invest 10,000 Rand, you get 800 Rand out every year in dividends. That's going to take you what? 12 years to make your money back in the cash flow, if you're prepared to hold it. And this share price is gradually going up. I think it's going to continue going up. Resilient business. I also like it a lot. Otherwise, I wouldn't be telling you what it is, and I wouldn't be putting it as my top pick, one of my top picks. Revenue, we looked at. Net income, we looked at. Total assets of the business, 7 billion Rand. Total liabilities, 2.28 billion Rand. Total equity after deducting everything, 4.7 billion. Look at the cash on hand. Current ratios at 3.4, which is excellent, even better than Prosus. So they are managing their money more prudently than a growth company. They might not be making as much, but these ladies and gents in this company know how to manage money, know how to make money, know how to allocate money, and know how to prudently invest it so the return comes back. Current assets, 5.1 billion, which is what they can sell right now, the inventory, the cash on hand, etc. Current liabilities, 1.5, that's the debt in the short term they must pay. They can cover that debt over 3 times. No need to take on debt. What they're doing is they take their cash flow, their net income, they pay it out in dividends, and they rebuy shares. They aren't really scaling their business, looking for bigger growth, because they're just taking that cash flow and distributing it. But the business is growing. Not like they're neglecting the business and saying, no, forget about the growth. Okay. So I like the business because of the cash flow they're getting out. Let's look at the technicals before we end the video. Since the pandemic crash, it hit a low of 12 Rand. That is incredible. that would have been absolutely amazing to buy. That would have been at like a 40% dividend yield or something silly like that. Don't quote me on that. I haven't done the calculations, but the dividend yield would have been between 20 and 40% if you bought at 12. That means it would have taken you 2 years to get all your money out, just about 2 to 3 years. If you bought at the pandemic crash with your money, if you put 10,000 at 12 Rand, it would take you 2-3 years to get all your money back. And then the money you invested would have still gone up 24, 36, like 300, 400% in the time. Would have been a great investment. So even if you don't want to buy the share, it's something to put on your watch list, because if they maintain their cash flows and the share price drops significantly, you're going to be buying a quality business very cheaply and get your money out very quickly in the form of distributions. So that's just how I invest. I look for capital that's going to be paid to me, but capital that can be paid to me in a sustainable way in the business. All right, so it's hitting its head now at 50. You can see it's popping its head there, but battling. It's going to pull back, in my opinion, because when it goes ex-dividend, when it says we're not paying dividends now anymore after this date, the share price will not tank, but it could sell off between 3-4 Rand, or maybe the same price as the dividend, 2 Rand, 1.95 Rand. Go back down into that yellow channel where you can see it's respected. As it hits that upper channel, the yellow channel here, it falls down, continues, falls down again. And then it's finally going to break 50, make its way up higher. As the share price goes higher, that dividend yield gets smaller and smaller, which means it takes more years for you to get your money out. So again, if this share price drops to 12 Rand, not financial advice, I'm selling my clothes, I'm selling most things I have, I'm buying the share. Not my clothes, sorry, let me not over exaggerate you. I'll sell my bike, sell whatever I need to sell, put it into the stock, and hopefully be buying some business that's still going to maintain their cash flow and continue growing, distributing money. So I like it. If you were going to buy after ex-dividend, wait for the share price to drop, hold it long term. Again, I want to express that all these shares are for the long term. Quickly to recap them: Prosus, Storage, Sibanye, and Lewis Group. Those are my 4 favorite stocks going into 2022. I think long term, even if you're going to hold them 5 to 10 years, I think they will make a diversified portfolio and they will do well, not only in capital stock appreciation, but also in distributions, in dividends. All right, thank you for staying towards the end of the video. I know it's been long. I hope you've got a lot of value out of this video. Again, hit that subscribe button for me, please. I would truly appreciate it. I'll see you in the next video. Bye for now.